Hey, everybody, welcome to the Zoom webinar for tax strategies for the passive investor. My name is Ryan Gibson, and today what we're going to do is we're going to kick off a Zoom webinar. We have Ken Williams from CLA, CliftonLarsonAllen. He's from our Seattle tax office. He's one of the tax leaders there and has been a CPA for a long time. And we're really excited the knowledge that he's going to bring to talk about if you qualify as a professional real estate investor, and we're going to talk about depreciation and all the things that surround it, like cost segregation and what's going to happen with bonus depreciation in the future. So without further ado, Ken, come on up. All right. So as we get started here, Ken, why don't you just give us a little bit of background? I give you a little bit of an intro, but tell us about yourself.
Yeah, so again, Ken Williams, I'm CPA, the tax leader here for the Bellevue office of CliftonLarsonAllen, and I've been involved with real estate investors for, well, more years than we really need to talk about.
Nice. So everybody in the crowd, just to kind of know the audience, I think everybody here is, they've passively invested in a syndication. They are real estate professionals to include, maybe but not by definition, we'll get into that, but real estate agents, mortgage brokers, house flippers, real estate developers. They might have some things that are never entered into service. They might have some developments. So just we kind of have a broad spectrum here today. And then maybe there might be somebody who's never even invested in real estate and they're thinking about it. So, so we're going to go ahead and just dive right in. And the first thing that we're going to talk about are passive losses. So I got it up on the board. What is passive activity? What are we talking about when we say that?
Yeah, and I appreciate your intro because you were talking about passive activity losses and qualified real estate professional, but also depreciation. And the two kind of go together because the passive activity loss rules largely stem from some of the depreciation advantages that real estate provides. And so you have to be really old like me to be able to remember back in 1986 when they came out with these passive activity loss rules. And what they were intended to do is, back before 86, it was a heyday because the standard strategy was if you had a lot of income from your business, from your wages and so forth, you would just go out and buy 100 rentals and use the depreciation from those rentals to create paper losses and use those losses to offset all of your other income. And so you heard these stories about people making all this money and paying zero tax because they had these tax shelters.
So you're talking about doctors, lawyers, airline pilots, whatever it is. You could be, it didn't matter what you did as a W-2 income, you could take all those passive losses up until 1986.
Right. Yeah. And you could just use those losses to offset all your other income. And a lot of those losses were generated because of depreciation. And if you were financing those properties, well, it didn't really cost you cash out of pocket, and yet you got that depreciation deduction and that use that to offset it. Well, everything changed in 1986. And Congress said, we don't like that anymore. And so they passed Section 469. You can impress all your friends at cocktail parties with Internal Revenue Code Section 469, which was the passive activity loss rules. And they basically said, you have to divide your income into 3 buckets. So your first bucket is your active income, your W-2 income, or if you operate a business, that's your active income. The second bucket is the passive bucket. And then the third bucket is your investment income, like dividends, interest, capital gains from securities, and so forth. And they said, you have to divide your income, and you can use losses from passive activities to offset other passive income, but you can't use those losses to offset other types of income from the other 2 buckets.
Gotcha.
And so it was really a way to say, well, look, we recognize that you have economic losses and we want to give you the tax benefits of that at some point, but we're not going to let you use that to offset all your other income. We just don't think that that's fair, that you should be able to shelter all this other income. So they created this little bucket, and a whole lot of rules came out of that. And so that was the genesis of the passive activity loss rules. And then what they said is, okay, if those losses net out to 0 or they go negative, whatever losses you don't get this year because they were limited, they carry forward, and you can use it to offset future passive income, or you can use those losses when you eventually dispose of that property, it frees those losses up. You can use that losses that was suspended to offset gain from that property, from other passive activities, or even ordinary income if you don't have any other income from passive activities.
So you said a lot there. Let's unpack it.
Yeah.
So basically, if you are a W-2 income earner, you're doing real estate activity, you may or may not qualify to shield that income anymore as easy as it was since 1986. So I think where we're going to go with the conversation today is how to pick that apart and figure out what you can depreciate, what you can't depreciate, what counts, what doesn't count, things like that against your thing. But the other thing I think you said that was really interesting is I had a situation this year where I have a cocktail quote or reference. I used a 1045.
Okay.
So I was a W-2 income earner for a number of years, transitioned into full-time real estate. And at the crossroads of that, it allowed me to take my suspended losses from the years of investing in real estate and look backwards 5 years and get a refund for taxes paid in the past. And then additional depreciation going forward. So I think, do you want to touch on that a little bit? Not my situation in general, but I think there's a lot of people in the room who are working a W-2 job and they're thinking about they're getting heavy into real estate. And eventually they might flip the switch and they're no longer W-2, but they've been buying stuff that generates this depreciation along the way. And it might be applicable to them at some point, depending on their situation, of course.
Yeah. And there's some real opportunities that people don't always recognize there. And so that's why this discussion is so worthwhile. So going back to the original rules, they would say, well, okay, if you're a W-2 employee and you're just doing real estate on the side, you can't use those losses to offset your W-2 income. Well, there were a lot of people that said, well, but what if my W-2 is from real estate? And that's what I do. There's nothing passive about it. One of the unfortunate provisions of the Section 469 was they said, well, activities that you're not actively involved in are passive, and real estate rental is automatically passive. They wrote that right into the code. They just said, we don't like real estate. We're saying it's passive no matter how active you are. Well, people who are involved in real estate said, well, that's not fair. And so they wrote some provisions in called the qualified real estate professional exception that says, okay, if you meet certain criteria, then we will not automatically assume that that is a passive activity. You still have to clear the threshold, but we're not going to automatically assume that it's passive. And that gives people, like in your situation, the opportunity to say, I'm in the real estate business. I'm spending all of my time in this. It is not a passive activity. And so I can claim those losses, those deductions.
Makes sense. And so if you're just doing real estate, do you automatically qualify?
Great question. No, but there's a good chance.
But let's say, I work all day on my rentals, right? And I work as a doctor or lawyer or whatever too. Yeah. But I spend so much time. I spend 500 hours a year or whatever the qualifying is. I spend all my time working on these rentals. Do I qualify automatically?
Yeah. No, unfortunately you don't. Okay. And that's where you have to kind of get into the specifics of what the requirements are for being designated as a qualified real estate professional.
Makes sense.
And I should point out that it's not an election. You either do or you don't qualify based on the facts. So sometimes there actually can be situations where you don't want to be a real estate professional, but if you meet the criteria, that's what you're left with.
So everybody's wondering right now, this one, who is qualified as a
qualified real estate professional. So the rules are you have to measure your personal service hours, okay? The time that you spend in that activity. And there are two criteria. So first, you have to have worked at least 750 hours during the year in services that are real estate related, okay? And we'll come back, we can talk about what that means too, what real estate related means. But second, more than half your time more than half the time that you spend has to be in real estate related businesses. Now, that's a problem if you're a doctor, because if you're spending, 1,500 hours in surgery each year, you're going to have a pretty tough threshold to get over, to be able to say you spend over 750 hours and over 1,500 hours in real estate related activities. And that's where the problem is. However, if your spouse is a real estate agent, for example, and spends both 750 hours and more than half their time in real estate activities, the nice thing is only one spouse has to qualify in order to be able to get it in. So I have a lot of clients.
If you file jointly.
If you file jointly, yes,
Correct, yeah.
An important distinction. But I have a lot of clients whose spouses are real estate agents, and they have to measure their time, but it allows you to work through that little loophole.
So you answered kind of the one of the questions, but one of our passive investors, who is a W-2 income earner that does not do real estate, let's say, that's the first part of the question, but they invest into a syndication. They're going to get a K1. It's going to have a huge loss on it. What happens to that loss? Can they apply it against their W-2 income?
Well, generally, no, unless they're a real estate professional. That loss is going to be suspended, not lost permanently, but it will be suspended. And to the extent that you have income from that activity in the future, you can then use those suspended losses to offset that income. If you sell that activity for a gain, likewise, that frees up those losses. You can use those. If you have income from another passive activity,
sure,
then you can use those suspended losses to offset income from that other passive activity.
So what you're saying is you can still use it, but it's a matter of how you can apply it to those ways that you've earned income.
Yep.
Offset it from the syndication, but not necessarily in your W-2 earned income.
Right. Right.
Now, let's just say a W-2 investor who qualifies as a real estate professional invests into a syndication and they get passive losses that way. Is that applicable?
Yeah, that can be a catch-22 there, because you may have a passive activity that is, well, let's step back from it. Well, let's say that it's a passive activity that's not real estate related.
Sure.
And it's generating a loss, and you've now elected to be a qualified, or you've got fact pattern where it says that you're a qualified real estate professional. Sure. Now you've just eliminated your income that could be used to offset that loss from that other activity. Sure. Now, if it's a real estate activity, then you can say, okay, I have to group. But the issue is in the grouping, and we should probably talk about that at some point, because that's part of the magic of the planning of how we do this. I said earlier that the status as a qualified real estate professional doesn't automatically allow you to deduct those losses. What it does is it says that activity that you're involved in is not automatically deemed passive, but the general rules determining whether an activity is passive or not still have to be met. The most common rule is over 500 hours spent in that activity. Well, there aren't too many, if you're, for example, have 10 rentals, there aren't too many rentals that you need to spend 500 hours on a year.
Sure.
But what the other thing that's permitted by this qualified real estate professional provision is it allows you to group all of your real estate activities, to make an election to group all of your real estate rental activities together to meet that criteria. So now, instead of having to spend 500 hours on each of your rentals, collectively, as long as you spend 500 hours on all of the rentals together, then you meet the test, and you can treat that as a non-passive activity and be able to claim the deduction.
So a lot of benefits from getting these deductions, a lot of tax savings, a lot of money in your pocket. I think what I'm hearing is talk to your CPA and your professional, because it probably depends on your situation, which we get this question all the time. How does this, can I take these losses and things like that? And we always say, well, generally, this is kind of how it works, but we're not CPAs. So go talk to yours, because your situation may vary wildly from everybody else.
Yeah.
Let's jump into, I think a lot of people have this question, I'm a high volume mortgage producer. I am a real estate agent. I'm a wholesaler or flipper. I have the couple of the listings up here on the screen. Who is qualified? We'll go one by one. Let's start with real estate agents. Real
Yes.
estate professional or not?
Yes, the real estate agent, that counts towards real estate activities.
Okay.
Yeah.
Probably the most basic one.
Mm-hmm.
What about a wholesaler? Somebody who is finding distressed sellers, assigning the paper at closing to an end buyer. Wholesaler, that's what they do. They do this full time. They might be doing 5 to 20 wholesales per month, et cetera.
Yeah, absolutely. That would
Okay.
be a real estate related business.
Great.
Yeah.
And then flipping houses.
Yep, that should count.
Awesome.
Yep.
And then mortgage professional.
That one, unfortunately, that one we got tripped up on. That actually some court cases that went, and in at least in a couple of circuits, the IRS was successful at arguing that a mortgage is not real estate. So if you're involved in mortgage brokerage, you're not selling, manipulating, acting, building, renting real estate. You're in the business of mortgages, and so that one they carved out.
Are there any things a mortgage professional could do to sort of get over the fence on that, or tweak what they do day to day?
Well, their mortgage activity itself, I think they're pretty much locked in, unless there are other things that they can do. If they can, you mentioned wholesalers, but where do you draw that line? If you're brokeraging mortgages, you're pretty much locked in to that business. But
makes sense. That
doesn't mean that you can't look at the scope of the other things that you're doing and still get your hours that way. You just have to meet both that 750 and 50% test.
Gotcha. And so you had this slide up about material participation. Can we talk about that? It was regular, reoccurring, or substantial.
Yeah, so that goes back to the definition of what is passive.
Okay.
And as we said, real estate is automatically passive unless it's not, unless you meet this qualified real estate professional requirement. But in every other category, and if you meet the qualified real estate professional, the threshold for whether it's passive is whether or not you are a material participant. And the code uses this language: regular, recurring, and substantial. And then they came up with 7 different tests. All right, because now why keep it simple, right? But really, these tests were intended to allow different circumstances to still prevail as a non-passive activity, because I realize there are a lot of situations where people should deserve these deductions, should be able to claim them. So again, the most common one is the 500-hour test. If you spend or 500 hours of your own time in that activity, then you meet the criteria. We don't want to go into all of the details of those 7 different criteria. Do you spend more time than everyone else? Do you spend at least 100 hours? Do you have specified participation activities where you might combine several activities that are more than 100 hours each to get over the 500? So there's lots of these different ways, and that's where you call your accountant and say, what do I do?
And they know those.
And we can work through all those and play 20 questions with you and figure out how to meet those criteria. One of the cautions is, and I've had a few clients that got caught with this, is for example, let's say that they work in a property management company. So they spend all of their year in
real estate.
But if they're not an owner in that property management company, as a W-2 employee, it doesn't count. So to count your W-2 time, as we're counting hours, in order to count that, you have to be at least a 5% owner in that activity.
Which is interesting, because if you're a real estate agent, you don't necessarily own the brokerage.
True. true.
Right.
But you're treated as a self-employed individual for
Correct,
tax purposes.
correct,
So you get to
correct.
count that time. You're not working for someone else. You're not getting a W-2.
Self-employment is really what drives that. So
Yeah.
unfortunately, for folks that own less than 5% of a real estate company, whether it's a real estate development company or whatever it might be, if it's W-2 income, does not count. That's a very good distinction. Yeah.
Right. Yeah. So if you're working for a real estate company and you own some rentals on the side, I've seen people get caught in that trap. They, I spend all my time in real estate. Well,
Right.
but do you spend 500 hours managing all your rentals, because we can't count the time that you're working for the management company, for example.
Makes sense. So let's jump into one of your examples.
Okay.
I've got it on the screen. This is the first one, kind of a passive loss example. I know there's a lot of numbers and a lot of things up on the screen.
Yeah, us accountants get excited about this, but everyone else just kind of, yeah.
I don't know if everybody can see this okay, but yeah, so this isn't grouped. This was your first example on the slide.
Right. So this was just going through, what if we didn't have passive activity loss rules, all right? If those rules didn't exist and we have someone that has wages and interest and capital gains from their securities, some retirement distributions, and they have an active business. So this is a business that they're involved in day to day, and it generated $150,000 of income. And then they have some passive businesses. Let's say that they invest in some other activity that had $125,000 loss, and they've got a rental that netted $15,000 of income. Well, we've got our three buckets: our active bucket, our passive bucket, and our investment bucket. And so we have to divide our income out and then apply the limit to the passive income. So in this case, we had $125,000 loss from our passive business. And because of the passive activity loss rules, we have to offset, we can only use that to offset $15,000 of our rental income. So that other $110,000 doesn't go away, but we don't get any benefit from it this year. It's going to carry forward to future years. So you'll see at the bottom, while our total net income was $335,000, for income tax purposes, this taxpayer had $445,000 of taxable income because of that limitation on their passive activities. This is what Section 469 was intended to do, to limit the ability to use losses from one activity to offset these other types of income.
And they're getting this passive loss here because there's depreciation in the year that they enter the property into service, or some kind of thing that triggers that, right? Yeah.
Right. It could be bonus depreciation, which
Sure,
we're going to talk about.
Right, right.
But yeah, from this passive activity, or it could be a non-real estate activity that just, COVID, it was a bad year, had a big loss.
So it's really any passive income or loss.
Any passive income, That's right.
All right, so let's go to the next slide, which this is with grouping.
Okay, so one of the things that you are allowed to do is to group your passive activities to get over that 500-hour threshold, to be able to characterize something as non-passive so that you can use those losses to offset other types of income. So in this case, what we did is we said, well, the best example would be a movie theater and an ice cream shop, okay? You could argue that those two businesses are related. The ice cream shop is right next door or in the movie theater.
Sure.
And you can say those are related businesses and activities. So while the movie theater may have lost a bunch of money during COVID, the ice cream shop made money because people were looking for something to do. And so in this case, we're able to group those two activities, and just by moving that $125,000 loss from the passive category over to the active category, we now have solved our passive problem. We still have $15,000 of passive income. That's fine, because we were able to benefit from the loss from our passive activity by grouping it with our other activity. And now our taxable income is equal to our income as we would calculate it.
Sure.
So just by grouping things, and there are all kinds of rules about grouping, which we can talk about, but that illustrates how grouping can help mitigate the consequences of passive loss rules.
Again, just kind of bringing this awareness that this stuff exists, I think is important. So, that there's all, I always joke, when people, I do my taxes on TurboTax or something like that. I'm like, you have a lot going on. You should probably talk to somebody about the different advantages. And this would be a great example.
Yeah.
Okay. Grouped rentals for a qualified real estate professional, that QREP, that's what that stands for. That's what we've been talking about. So this is somebody who's 750 hours a year in the right category, who has group rentals.
Great. So in this instance, we have, because we have said we've made the election, which I should point out is an irrevocable election. Once you make that election to group all of your real estate rentals together to be a qualified real estate professional, you're now locked in. So you cannot revoke that election without commissioner approval or change in material facts and circumstances. So in this case, we've made that election, we've cleared the 750 hour and the 50% thresholds, and we've spent at least 500 hours in our real estate activities. And so we're able to say, I am a qualified real estate professional. My activities are not per se passive, and I meet the requirement for material participation, throwing a lot of words out there. Therefore, I can treat all of those things that were passive as active. So we've now shifted everything over. We've shifted the 15,000 over. And we're kind of in this situation, we're in the same place. We have been able to use all of our losses to offset our income. So that's another way, because we may not have been able to group our two activities. Maybe they don't qualify for grouping, but by meeting this QRP or QRE, we're able to get to the same place.
Great. And if you don't want to group those rentals, because you don't want to have to undo it or it's unrevocable.
Right. So in this case, we said, okay, I'm a qualified real estate professional, but my business activity doesn't meet the criteria. Let's say that's not a rental activity. Well, you can't group non-real estate activities with real estate activities. Gotcha. And so in this case, it was a bad situation because our loss was able to offset our other passive income, but we didn't get all of it. So again, this is part of the gamesmanship, but you've got to kind of go through and say, how do we get the right facts to be able to claim the maximum benefit? Sure. Yeah.
So before we go into depreciation, let's talk about key takeaways. Mm-hmm. So 750 hours a year to be a professional. And you said logging hours. Does this mean I have to have a logbook everywhere I go, and every minute and second I've got to turn into you, my CPA, at the end of the year, so that you can turn it into the IRS? Or is it how does that really work?
Boy, I hope not. But
does this count as an hour, by the way?
Yeah, yes, okay. You bet. Yeah. Write it down. Track your time.
And I'm selling logbooks in the back of the room. Get your credit card out.
That's right. So the answer lies somewhere in the middle.
Okay.
The requirement is that you meet the hours. That's what's in the code. The IRS has been successful in issuing regulations and rev rulings and so forth, saying you need to have contemporaneous records. Okay.
Sounds like an IRS word.
It does. It does. They love that term, contemporaneous records. But this is a situation where you can win the battle. You can win the battle but lose the war. You can have all the right facts, but the IRS can say, okay, but you're not able to substantiate it. Therefore, we can disallow the deduction. So what does that require? Does it mean that you have to have the logbook and that you've submitted it and so forth? Well, no, but there are many court cases where the IRS has been able to prevail because the individual taxpayer has the burden of proof that they spent the requisite hours, and it has to be contemporaneous. Now, I love this issue of contemporaneous. Some of you may have remembered it. I think there was if you remember the old show Cheers, and Norm was a tax accountant.
Oh, right.
And he was under audit, and the IRS agent wanted to see the mileage log. And he produced the mileage log, and the agent said, what do you want to bet if I took this back to my lab and had them test the ink, they would determine that it was written within the last 24 hours? To which Norm, without even missing a step, said, well, you're going to penalize me for copying it over for neatness? And,
Nice.
So, but you do have to have those contemporaneous records. Now, that can be your calendar, that can be a logbook, that can be an appointment schedule, that can be your cell phone records and emails and so forth to substantiate those numbers. But it has to be credible. And there's one court case where the court threw out the case. It was a physician who did a certain amount of surgeries. I think he counted 1,500 hours of surgery time. And so he had a pretty high threshold, but he produced a log. A, it wasn't contemporaneous. B, there were some little problems, like he indicated one day he spent 24 hours putting ads for listings on, and the IRS said, well, that's not reasonable, that's not credible. And so they threw it out. And so you do have to meet some reasonableness test. And so the best thing is to have a calendar, be able to point out how you spent your time.
Yeah.
And I think it's one of these areas where, pigs get fed, hogs get slaughtered. The IRS knows an easy mark when they see one.
Now, what if somebody is just absolutely grinding it out, killing themselves, working a full-time job, making good income, 150 plus a year, 100,000 a year, whatever it might be, but they're also grinding it out doing real estate. And they get the W-2 from their employer, and it's got a nice salary on it, but they know deep down in their heart they've been a real estate professional. What happens at tax time?
Well, unfortunately, you have to find a right fact pattern to be able to claim. You can't just say, in my heart of hearts, I know I'm a real estate professional and therefore I should be able to deduct it.
Let's say we put in the time. We did the hours. How does that, and it comes to the tax season and I'm sitting down with you and I'm saying, can I work my butt off in real estate? I also managed to do a full-time job at the same time, because I know a lot of people here have done that. How do we get the right categorization for what we do?
Great. So first of all, this is a great question. First of all, we want to start with a question and say, do we want to be a real estate professional? Because as I said, sometimes you find that, and there are scenarios that it can flip on you. You can use it to your disadvantage. So we start there. Then once we know, we use these terms pigs and pals, okay? Pig is a passive income generator. PAL is a passive activity loss. And so you have to know, which are my pigs, which are my pals? And then how do we marry them up to get the most tax benefit? So assuming that we want to do that we want to be a qualified real estate professional, then it's a matter of saying, okay, what activities do we have to group if we make the election? Let's look at your hours. How many hours you spend at work? Can we meet the 750? Can we meet the 500? And or what if we don't meet those criteria? Can we flip back to look at the other rules with regard to passive activity loss limitations and say, is there something we can do there?
Sure. So it really depends, and it really depends on your tax strategy. So talk to your CPA.
Yeah. Good answer.
Depends. The other takeaway I had was marry a real estate agent and file jointly.
That's right. That's right.
That's the easiest way to do that.
Yeah, and make them work.
And make them work.
Yeah, that's right.
Make them work the 750 hours.
That's right. That's important.
Okay. So, we talked about mortgage brokers not qualifying. What would you say is the other professional that kind of touches real estate that is the most, unfortunately, you don't qualify? What's the other trade inside of this space? Because I would consider a mortgage professional. I disagree with the IRS on that.
Yeah.
Which other ones are most commonly in this space disqualified from a QREP?
So there are some carve-outs from rental activities. For example, carved out from rental activities are short-term rentals, like your Airbnb, your 7-day or less. Hotel activities qualify as a real estate business, but not as a rental activity.
Interesting.
And it's just
So
your rental activities that get you over the threshold.
So you said a very hot topic investment right now, which is short-term rentals, STRs. So you're saying if I'm doing 100% STRs, I'm not meeting the definition of a QREP.
Well, you are in a real estate activity, a real estate related business. So that gets you over the 750 hours.
Sure.
But you can't include that activity in your grouping for whether or not you meet the material participation requirements.
Okay, gotcha.
And so that's an important distinction. Now, that activity may, if it generates a loss, it may still qualify, but it's all in the grouping as to whether you can use that to qualify as a QER.
What about title agents, escrow agents?
So yeah, title agent, those are generally going to be in the real estate profession, so you should be able to count that. If you're, I'm trying to think of other examples. I don't have my list here in front of me.
That's okay. I think the short-term rentals was a good one because that is the hot asset class of today, and a lot of people our investors are moving in that direction. So that's great. Okay.
Now you could, again, that's just to meet the real estate professional. You could, if you had 10 different rentals,
sure,
short-term rentals, by definition, they are not rental real estate. So you fall under the general rules. You could group all those activities together.
Gotcha.
And still be able to meet the threshold. You just can't combine it with your other rental activities.
The grouping is something new to me. I didn't realize that went on the back scenes. So that's really, really important to know. And the material participation I wasn't super familiar with. So that was very helpful.
And I should point out that the grouping in general, we talked about the election for real estate professionals to group all of their rental activities. But even remember our ice cream shop and the movie theater, we can make that election, but that is also a permanent election. Once you make that grouping, you can't ungroup it. So you're kind of stuck with it. Now, if you had another business, you might be able to group that in, that you acquired, you might be able to group that in later, but you can't ungroup those activities. And that's where a lot of the creativity comes in. For example, let's say that I have a movie theater in 3 cities and I have an ice cream shop in those same 3 cities. Well, I can look at, do I have a pig or a pal, and what do I want to group? And I can either elect to group all 3 of my movie theaters together as one activity.
Sure.
And my 3 ice cream shops together as another activity. Or I could group geographically and say, Seattle movie theater ice cream shop, one activity. LA movie theater and ice cream shop, another activity. So there is a lot of opportunity, but those groupings are fixed. And it's not an election that you state on your return, just the way that you handle on your return is treated as a grouping. So
interesting.
Yeah.
We're going to switch gears. We're going to jump into depreciation, my favorite topic, which is driving a lot of these losses. I'd say probably 95% of your losses in real estate are coming from depreciation. So everything that we talked about on how to qualify this really comes from depreciation. And I think there's an important distinction between depreciation, but we'll first start with cost segregation. And actually maybe zoom out, talk about just basic depreciation, 39-year commercial life, 27.5-year residential, and when can you apply it?
Yeah, sure. So the general rule is when you acquire a capital asset in your business, or it's a business asset, or whether it's a building or residential or commercial or whatever, you don't get to just expense what you paid for that building. You don't get to spend $5 million and just claim it as a deduction. You're required to depreciate that over time, over its economic life. Now, economic life has slowly evolved into statutory, this is the life that thou shalt use for this type of property. And so there are the modified adjusted recovery, I can't remember the acronym now, but MAKERS is what we call it.
Sure.
That specifies for this type of asset, this is the life that you use, and this is the method that you use for expensing a certain amount of that asset over time. Land, you can't depreciate it because it doesn't, in theory, doesn't decrease in value. But a building, you can say wear and tear and obsolescence, it's going to decrease in value over time. And so you claim that deduction over a period of years. Commercial real estate, generally 39 years. Residential, generally 27 and a half years. So that's the rules that we've been operating in since 1986. And those lives sometimes will change, but that's the rules that we work with. But the nice thing is that's a paper loss. Yes, you paid cash for that item when you bought it, but each year you're getting a paper loss. And that's what a lot of times generates these losses. You may have a rental activity that's positive cash flow, but it's generating a negative taxable income because of that depreciation that you're claiming each year.
So what you're saying, if I buy a self-storage, which is a commercial real estate business, I can depreciate that asset over 39 years. So I'll attempt to do math in public, and hopefully that I move my decimals the right way. So let's say that asset is $390,000 when let's say the asset's $400,000, and let's just say the land is only worth 10. So I can't depreciate that.
Right.
So I would take 390,000 and I would divide that by 39 years, and that is the loss I get every single year automatically.
Right.
Okay, so everybody's tracking that. For residential, that's multifamily.
Multifamily and
Single family?
27 and a half.
If somebody is occupying the space and lives there, basically, it's residential. That would be 27 and a half years. So let's talk about cost segregation. So that aside, you can actually even further accelerate the depreciation on a building by doing a cost segregation study. And you can hire someone to do this. CLA actually does ours. It's just easier now because we do so many of that. We do like 40 a year. So the coordination between the cost seg study and the our accountant, they have to come together, and there's some intermingling there that takes time. So it's easier for your firm to do it for us, which is great. But if you're just doing a couple a year, one or two, there's some great firms out there that will do them for you. But talk about cost segregation. What is it? What is it not? What are those misconceptions? And,
So cost segregations are an attempt to optimize the depreciation, the timing of the deductions that you can claim on your properties. Obviously, a deduction today is worth more than a deduction 5, 10, 15, 30 years from now. And to the extent that we can accelerate those deductions, all the better. We get those deductions now. And if we're a qualified real estate professional, we can claim those deductions against all types of income. So there's a real incentive to do this. Now, we said that commercial property was 39 years and residential property was 27 and a half years, but that's for real property. Now, personal property has much shorter depreciable lives. So this is the first leg of cost seg studies, is getting items that normally would be treated as 39-year property classified as 5-year property or 7-year property or 10-year property, so that you can claim that depreciation much more quickly and get the tax benefits of the money that you spent for that building up front. So that's the first leg, is what we do in a cost seg study. And we actually have, engineers that will go in and they break out that building and they say, well, the shell of the building, that's 39 years. But all of the electrical and the internal wall space and all of the different elements of that building that are not structural components, but internal parts of the building, we can classify some of those as 5-year property, 7-year property. And as a result of most recent tax law changes in the last 5 years or so, this separate category called qualified improvement property. And qualified improvement property is 15-year property. But the magic only starts there. And that's where we get into bonus depreciation.
Sure. So just really quick, we're sitting in this office building. And so what you're saying is the concrete masonry block, the beams that have been here for almost 100 years, that's the building envelope, right? But the kitchen cabinets back there in the office kitchen, those are going to be the things that you can break out. The HVAC ducting you see that's piping through the office, that's what can be broken out and cost segregated. How do you apply a value to that? How do I How does the engineer say those cabinets are worth X amount? Is it just kind of a rough guess? Do they take pictures? Is it an estimation? Do they take the actual value of what they are today, or maybe what the replacement cost would be? How does that kind of work?
Yeah. So what our cost seg team will do is first of all, they will get copies of the blueprints and the constructions and so forth. They will go through and they look at the electrical and they say, okay, well, here was the total cost of the building. It's still based on actual costs, what you paid for that building. But then they're going to go through and they're going to allocate that cost to the underlying cost. So they're going to look at this building and they say, okay, the electrical system is worth this much. And the HVAC is worth this much, and these internal walls and carpet and fixtures and so forth. This is what the cost element is. They're going to look at all the invoice history and break those costs out, allocate them as needed based on their understanding of the labor costs and build out costs. And they're going to take that total cost and break it down into these different components and then say, okay, these can be depreciated using this life. These can be depreciated using a shorter life.
And the total depreciation is all based on what you paid for the building, not what it's actually necessarily what the old owner did or anything like that. It's what you paid for the building. Is that correct?
That's correct. Yeah.
Well, great. Okay, so let's dive in now. Okay, so now we've taken the 39-year life. So that's the 390,000 I talked about divided by 39 years. That's what you get. But then you further accelerated your depreciation by doing a cost seg study. Now there was this new thing that came out in 2018?
2017.
Yeah. That was called bonus depreciation. So what did that do to help us out?
Yeah. So bonus depreciation has been around in one form or another for many years.
Oh, interesting.
But in 2017, with the intent of stimulating the economy and incentivizing businesses to invest more, they said, normally what you would have to depreciate it if they are qualifying assets, you don't have to depreciate it, you can expense it. But the next question is, of course, what's a qualifying asset, right? Well, they didn't go so far as to say a 39-year building is a qualifying asset, but they did say initially, and there's been some changes over the years, but now it's this qualified improvement property or that are looking at the non-structural components of the building, leasehold improvements, all of those things that are on the inside of the building. When you spend money on that, or if we allocate money to that in a cost seg, we can take bonus depreciation, meaning we can expense 100% of those items in the year that it's placed in service, rather than having to spread it out over 5, 7, 15 years that we used to do under cost seg studies. So cost seg studies used to be great because we could get 39-year down to 5 or 7 year lives for a significant portion of the cost of the building.
Right. When
they came up with bonus depreciation, it was a home run because now we're not spreading it over 5 or 7 years. We're claiming all of that deduction in the first year that it's placed in service.
So if those cabinets were entered in at $10,000, instead of having to depreciate $2,000 a year over 5 years, $10,000 deduction straight away.
That's right.
Great.
Yeah.
So everybody asks, well, I know that when you sell the asset, Ryan, you're going to get recapture tax.
Yeah.
And how does that work? And why would I want to do this bonus depreciation if I'm going to have to pay recapture tax? What are the advantages there? And I had one CPA tell me that it always makes sense to bonus depreciate, regardless of how long you intend to hold, because you get the savings up front and the recapture tax is less. I mean, let's unpack that myth or verify that rumor.
Yeah, it can cut both ways. So it is probably not that cut and dry for certain types of property.
Sure.
For our 5 and 7 year property, I would tend to agree. Unless you've got significantly different tax brackets in one year or another, why not get the deduction now, even if you have to take it back later? The concept is this. If I buy a building and I depreciate it, let's just go back to our 39-year example.
Sure.
If I buy a building and I depreciate it over time, that depreciation deduction is an ordinary deduction, meaning it offsets ordinary income. If I have other types of income that I'm taxed at 37%, that depreciation deduction reduces that ordinary income. So it's saving me 37 cents on the dollar.
Amazing.
So pretty good deal. Well, it's a good deal. It's a little too good a deal when it comes to when I sell that building. And for other types of assets, 5-7 year property, Congress has basically said, when you expense or depreciate a 5-year asset, and then you sell that asset later, to the extent that you sell it for more than its depreciated cost basis. In other words, I paid $10,000 for an asset, the cabinets. I paid $10,000 for the cabinets. Let's say that I depreciated $7,000 of that. So now my net book value is $3,000. That's my tax basis. If I sell those cabinets for $5,000, Congress has said, okay, that $2,000 gain, we're going to make you recapture the depreciation, the $2,000 of depreciation that you took. You have to treat that as ordinary income, whereas normally if you sold an asset, it would be capital gain, right? You would only be taxed on 15 or 20% of that gain, but you have to recapture the depreciation you've taken. So that's the recapture rule. And for real property, they have a separate set of rules because that's what Congress does. They said, well, you may not have to recapture that as ordinary income, but that's going to be what we call 1250 gain. 1250 gain gets taxed at 25% to the extent of depreciation that you've taken on real property.
And that's how most of ours, I think, would be handled.
Right.
In the case of self-storage investing that we do. So
Right. But in the case of a self-storage, if you take bonus depreciation, because you did a cost seg and you said lighting and fixtures and so forth, that's not part of our 39-year asset. We're taking bonus depreciation on that. Then when we sell that property, it's going to be 1245 gain. It's going to be ordinary incomes to the extent of depreciation taken. Still, you got the deduction up front. You got the use of that money. If you have to pay the same amount back later, it's still worked out. And then anything over the depreciation you've taken is still capital gain. So you really haven't lost anything. You've gotten the temporary use of that money.
Makes sense. So for those investors out there that are really trying to take advantage of bonus depreciation this year, because I think we'll talk about that in a minute, but what is the best piece of real estate you can buy to get the most depreciation based on your purchase price? Or the top three?
Oh boy, I have to think about that. I think part of it is depending on what your window is.
Okay.
The type of property you're going to invest in, but assets where you can get all of these tax benefits up front. If you're not going to meet the qualified real estate professional, then maybe the bonus depreciation doesn't do a lot for you. But if you've got an asset that where you can do a cost seg and a significant portion of the cost of the building can be expensed, then that's a pretty compelling argument to be able to get all of those tax benefits in addition to, the economic benefits of that real estate investment.
Makes sense.
So, self-storage is a great example because you're able to get all of that tax benefit up front, and still, it's something that's going to appreciate, and you're going to get the upside with those upfront tax benefits, as opposed to something that is just a warehouse shell.
Sure.
And there's no infrastructure.
Correct. Yeah. So let's talk about the bonus depreciation. We talked about the history. Mm-hmm. Let's talk about future state.
Yeah.
Is it going to be around forever?
Yeah. Well, the only thing permanent about tax law is that it's not permanent. And so we always have to kind of be looking at what's going to change. And bonus depreciation already had, while it was enacted in 2017 and they've tweaked it a little bit between now and then, it is set to sunset over time. So 2022 is the last year that you get 100% bonus depreciation. And then in 2023, that drops to 80% and you have to depreciate the balance. And then the next year it drops to 60% and so forth, 20% a year until in 2026, we're all done with bonus depreciation. Now that's the way the law is written right now. I've been in this business long enough to know that's not the way it's going to turn out. They will do something else between now and 2026. We just don't know what it is that they're going to do.
Is Congress even talking about it? Or are there proposals right now going through?
There are lots of proposals floating around on Capitol Hill, and they've got I just picture in my mind this giant storage room where somebody has an idea, they write it down and they put it on the shelf. And then every time the legislation comes up, they kind of go through and, well, let's try this one, let's try that one. We see a lot of the same provisions getting recycled in different drafts of legislation. So there are lots of proposals out there. And bonus depreciation was one of those proposals that kicked around for years before they finally passed it. So there are lots of things, but there's nothing that I would point to and say, that's where I'm going to put my money.
So the key takeaway is this is the last year you get 100%, but you still get a significant amount next year and the year after.
Yeah.
And you still get cost segregation acceleration. So it's not like it's the last year to go run out and buy something. It really is just, it's just getting gradually less effective right up front.
Exactly.
Yeah.
We were doing cost segs long before bonus depreciation, and they're still provided these significant tax benefits. It's just that, you know, we're feeding at the trough of bonus depreciation right now.
Sure.
Eventually they're going to turn the spigot off, or we think they will, but there still are advantages to doing those cost segs and getting those tax benefits up front, just maybe not quite as aggressively.
Great. I'm getting questions here from the Zoom chat, so I'm gonna take a couple of questions. We're just about at the end. Thank you, by the way. Does time spent analyzing and acquiring property count towards time spent on real estate?
Yes. Yeah, absolutely. Track that time.
I don't spend much more than 100 hours in my rentals, most of my time in buying and selling. Do I still qualify as a qualified real estate professional?
Great question. So again, you have the 750 and 50% test. It sounds like this individual would meet that requirement as a qualified real estate professional. Then you have to say, okay, if we group all your rental activities, can you treat those as material participation? And that's where we'd have to go through those 7 tests to see, do you meet one of those criteria?
Sure.
Chances are if you're spending 100 hours and you're not paying other people to manage those properties, you probably can get there. If you're still paying a management company, then we'd have to talk.
Question from David. I've heard that suspended losses from bonus depreciation and 5- and 7-year property can be applied to offset ordinary income when the asset is disposed. If the apartment building is sold, there is a capital gain on the real estate part and a 5- and 7-year property is worthless and the depreciation is freed up to use against W-2. Does that sound wrong? Thoughts on that?
Yeah, so the person's right in that any suspended losses are available to offset income in the future, whether that income is ordinary or capital gain. You offset those losses first against other passive activities, and then if you have a net loss for that year, that loss is then available to offset income from non-passive activities.
Great. Well, thank you so much for coming in. We're going to go ahead and thank everybody on the Zoom webinar and say that next first Fridays of every month, we have an expert panelist come in and talk to us about benefits of passive investing, tax strategy, other asset classes, things like that. So we hope we can join. You can join us on the next one, and we'll catch you on the next webinar. Thank you.